Hey, Bob.
Hi, Eric. How
Everyone
you
here?
doing? You and me.
Hey, all right.
Just
Guess
you and me so far. I got your Major League Baseball hat on, huh?
Oh yeah, yeah. I haven't showered this morning or anything like that, so it's easier just to put the hat on.
Yeah, I was in the shower too, but I'm not fooling anybody. So, all right,
Yeah.
let's see what kind of a crowd we draw today, huh?
Oh, there we go. Someone else.
Hey, Natasha, how you doing?
Hi.
Hi
How's it-
there. You say hi to Eric. Eric, Natasha, you two know
Hi,
each other
Eric.
by
Hey,
now.
Natasha.
Two
Yeah,
of
we
my
do.
regulars.
This is the fun part
Have either of you taken the test yet?
for this
Well,
chapter.
The test, I think, is already available.
Oh, you mean the one that's due on Thursday?
There's a test that begins that it looks to me like if unless I made a mistake, Cornelia made it available already.
Oh,
the
the midterm or whatever. Is that
Yeah,
what you mean?
there's one midterm broken out into two groups. The first test will be on chapters 1 through 3, and then the second one on 4 through 6. The one test, I guess, is due tomorrow, roughly, and the other one is Thursday. And it'll
Oh,
be up there. You'll just have to look at the schedule. If you have any questions, let me know. We'll clear them up. All right. Hi, Patty. How you doing?
Okay,
Good
there we
to
go.
see you.
Unmuted. It's
Christine.
doing good, but from what I can see, it says they're doing the 3rd and the 5th.
Yeah, that's all. Look, I'm like,
Yeah, so Thursday, Saturday.
Okay.
Chapter 6 is due
Cool.
tomorrow.
yeah, because I was like, oh no, it's due tomorrow. Because I know tomorrow we have our normal quiz.
Yeah, I forgot that there was like 31 days in May. So yesterday I was looking at the thing. I thought chapter 6 was due today. I was like, oh God.
Oh, that
Hmm.
tricky calendar can throw us off sometimes, huh?
Yeah.
Hi, Christine.
Hello.
I guess we're
Hello.
ready to go. We have a nice crowd here. We have 5 faces. Counting me, we got 6 mugs. That's good. We're going to go over chapter 6, which is not a long chapter, but it introduces to you the final step in the closing process. Oddly enough, it's called closing entries. And we're going to get this wrapped up here in a second. Oops. You can see the PowerPoint now, right?
Yeah.
Okay, Patty gives me a thumbs up. That's good. Financial statements in the closing process. We learned that at the end of the month, we do the income statement first because we have to get the net income in order to roll it into the statement of equity to get the new equity number. And then we do the balance sheet and we take the new equity number. But you might have noticed that we didn't do any journal entries yet to actually move the revenues and expenses over to our balance sheet. And that's what this chapter is about here. These are called the closing entries, the closing process. So we have the worksheet, which you're getting familiar with now. The worksheet, you journalize your adjusting entries and you prepare the financial statements. That's how far we got on chapter 5. We went through the worksheet all the way up to the point where you do the financial statements. Now we're done with the statements. We can take a rest. We go, we're done. But there is one more thing we need to do, and that is to close out certain transactions. Specifically, you close out the income statement, the revenues and expenses. So they're reviewing the worksheet, it looks like a little bit here. And remember the order of presentation, it cannot be done any other way. Income statement, equity statement, balance sheet, 1 feeds 2 and 2 feeds 3, huh? They're giving you some tips on preparation. Yeah, you start with the company name and the title, and the period ended, whatever the period ending date was, as of this date, not as of. I'm so sorry. Let me change that again. Income statement, since it's an accumulation of numbers that go up, and they don't go down, they go up as the month goes on. You want to say month ended for the month ending, for the month of. I don't care what you do with dollar signs. Revenues are shown first. We should know that, huh? Expenses are shown next. Expenses are listed in account number order. You can't really list them in descending order by dollar amount. That doesn't make any sense. You never be able to compare the two statements from period to period because certain expenses might go up or down. So the expenses are listed however you want to list them. You can do it alphabetically. You can do it according to the chart of accounts, probably the most normal way, okay? We're going to total those expenses and come up with the net income. So here's what we're looking at here. Here's our worksheet. Partial. They're just showing the income statement portion of it. So you can see how, I don't want to use the word easy, but you can see it's not that bad. You're just copying this information from the finished trial balance. Your sales are 8,000. Here are all your expenses. There's your profit of 4,640. 4,640. Okay. So I'm assuming that's not too tough a statement to put together. Revenues minus expenses, sales minus expenses. Statement of equity. Now that we know the income, we can update the owner's equity, the owner's capital. Capital from the worksheet may not be the beginning capital account is the beginning. That's just to confuse us. Let's not even worry about that. We're going to show this statement. And this also comes right off of the worksheet. Right off the worksheet. Let me go back to the worksheet. Mitchell Capital, $5,000, huh? Net income, 4640, drawing 3. Here it is again, right here. Oh, they're not showing you on that. I'm sorry, guys. They're making me look bad here if they're not showing the worksheet. But you get the idea. The investments, you have a beginning balance of 5,000. The income went up. We had income rather, 4640. We drew out 3,000. We end up with 6,540. And then it goes into the balance sheet. Liabilities and owner's equity are shown below the assets, huh? We kind of know that already. Assets section is on the left, liabilities on the right. You could do it that way, or you can do it the assets on top and liabilities and equity on the bottom. Remember what the balance sheet is. It's the accounting equation. It is the assets totaled down one side of the paper, the liabilities and equity totaled down the other side of the paper, and those two numbers must agree. Classified balance sheet. Let's talk a little bit about something new here. Current assets and current liabilities. You've not heard that expression yet. Current assets, current liabilities. A current asset is an asset that we're going to use within a year, within a fiscal year. Current asset, cash. You're using cash every day. That's a current asset. Accounts receivable, inventory, prepaids. Those are your current assets. Those are the assets that are turning around all the time. We don't have inventory that sits around for a year before we sell it. If we do, we might have a problem. We might have a product that nobody wants to buy. Same thing with current liabilities. Current liability is a debt that we expect to pay within the fiscal year. That's all that means. Current liabilities. And when we get into a future chapter toward the end of the course, we'll do some analysis of looking at these current assets and current liabilities and getting a judgment on how a company might be doing. The non-current assets, you can call them fixed assets. Fixed meaning they're set in stone. They're going to be there a long time. Your property and equipment and your long-term liabilities, maybe a mortgage. Current assets, current liabilities. Understand what those mean. Current assets converted into cash or consumed within 1 year, whichever is longer. And look at your current assets, cash, accounts receivable. And they're talking about the operating cycle. Let's just look at this fairly quickly. You start with cash. You start a business, you've got cash. Then you go out and you buy motor scooters like Mitchell Williams did. And then you deliver your pizza like he did. You collect your receivables and then convert back to cash. Just a cash to cash flow is all they're talking about there. Here are your long-term assets, fixed assets, assets that are gonna be around a long time. Plant assets are long-term assets, land, buildings, equipment. And remember, the value of these items may have nothing to do with what the market value really is. Current liabilities. Liabilities due within a year, fiscal year is really what they're talking about. And they'll be paid with current assets. Well, we know that. We're gonna pay them with cash. Accounts payable, that's the very definition of a current asset. You pay no vendor's gonna sell you a product and say you have 12 months to pay. It'd be lovely if they did, but it's not how the world works. So accounts payable typically is a 30-day commitment. Wages payable, accrued wages payable, the journal entry we learned in chapter 5, that's classic current liabilities because you're going to be paying your employees in a couple of weeks. Long-term liabilities would be notes. You borrowed money from somebody. And the deal is you borrowed $100,000 today and you don't have to pay that money back for 10 years. 10 years, you don't have to pay it back. Well, what you do have to pay is interest every year of, say, 10%. So that would be $10,000 a year in interest you're paying every year. And that interest would be a current liability because it's due once a year. But the principal to be paid in 10 years is a long-term liability. Same thing with other kind of transactions. And they're just giving some tips on presenting the balance sheet. Current assets are listed first. We know that. Same thing with liabilities. And the capital account, and this is the important thing we're trying to get through our heads here. The capital account on the balance sheet does not show the net income. It does not show the drawing because we're closing the net income and we're closing the drawing at the end of the month into the owner's capital. Remember what the owner's capital statement is: beginning capital plus net income minus withdrawals. Use the ending capital amount from the statement of owner's equity. And here we go. Balance sheet must balance. Who knew? Balance sheet relation. Well, here we go. Here they're showing the balance sheet a little bit, huh? And remember what I said, everything above drawing is your balance sheet. So let's see what we have here. Cash, bringing that over. They're bringing the accumulated depreciation over the 80. I see the 1900, everything. What's different here is your capital here was 5,000. But look at your owner's equity statement. It's not 5,000 at the end of the month. It's not. It was 5,000 at the beginning or at the end of the month before we did our closing. 5,000 plus your net income minus the drawing. This is what's going to appear on the balance sheet. That final number of 6640. The owner can invest more money as the business goes on. You just have to be alert for that. You might get a problem on the test where it says Johnson opened up a business with $10,000 on January 1st. And then they'll say something like he invested another $20,000 on January 15th. Just to be remember to add those two together to get the total beginning, if you will, equity. Wow, there's a lot of additional investments by the owner, more than we really need, I think. We will illustrate additional investments using another business. Oh, we're finally getting away from Mitchell. Ramon Balboa. He was a fighter, wasn't he, in Philadelphia? Balboa? Or that was Rocky Balboa? I'm sorry, my mistake. Ramon Balboa, capital account had a beginning balance of 5,000. During the year, he invested 3. The $8,000 balance in the capital account will show up in the unadjusted trial balance. That's going to be your new ending, if you will, before we close. And I don't think that's too tough to understand. And they're just showing it here. You look on your general ledger. You look at the journal entry here on the general ledger. You had a balance of 5 to begin with. That was your balance. He put 3 more into the business. That's 8. And they're just showing you how to present it down here. You had a beginning balance of 5 in July. He invested another 3, that's 8, plus his income minus the withdrawals, okay? Journalize and post closing entries. Now we get into the guts, okay? You have 2 kinds of accounts. You have permanent accounts and temporary accounts. Let me make this easy for us. Permanent accounts are anything on the balance sheet. Balance sheet, permanent. Balance sheet, permanent. At the end of the month, we don't close, we don't zero out cash. We don't zero out inventory or accounts payable. They are permanent accounts. They go on forever as long as the business exists. They're not closed. Permanent accounts, balance sheet, not closed. These are the ones that are closed. Temporary accounts, and let me make this easy. You ready? Temporary accounts, the income statement. Anything on the income statement is what we close, because we have to take that income and increase the capital by that amount of net income. So what are we talking about? We're talking about we're going to zero out or close. We're going to close the revenues. We're going to close the expenses, and we're going to get rid of the drawing, because you're not going to show the drawing on the financial statements, okay? These are the ones that are closed, your income statement plus drawing. So what we're going to do is we're going to give temporary zero balances to accumulate the new information. Let me just move this over here a little bit. I can't quite see what they're saying. Okay, the closing product gives temporary accounts zero balances so that they are prepared to accumulate new information. The income summary account is going to be used. The income summary account is an account that is in your general ledger, but it never appears on your financial statement, and it never has a month-end balance. It is just a clearing account that I'll be demonstrating in a moment. We are going to get rid of the revenues, and we're going to debit it, and then we're going to credit this clearing account. So let's see if we can start up here. Closing process steps, 1, 2, 3, 4. This is a very good presentation of what we're talking about, okay? You know, sometimes I criticize the slides, they're not good. This is really good. First thing you do is close the revenue accounts. What kind of normal balance do revenues have? Anybody want to shout out the answer to me? Revenues have a normal debit or credit balance.
Credit.
Credit, very good, credit balance, thank you. So how do we get rid of them? How do we get rid of those balances? With a debit. You're just going to debit whatever the revenue number is, and you're going to credit this income summary account, okay? Debit revenue, credit income summary. You might have multiple revenue accounts. You just debit each one of them and credit income summary. Well, revenues are increased with a credit, then we know expenses, the opposite, are increased with a debit. So we're going to take every single expense and we're going to credit them. We're going to credit them to create zero balances. And that means we'll be debiting the income summary. So at this point in time, the income summary balance is the net income. We're temporarily putting the net income as the balance of the income summary. And then at that point, all we have to do is debit the income summary for the net income and credit the owner's capital. Okay, that's the third step. The fourth step is pretty easy. Fourth step, you credit the drawing to get rid of it, and then you debit the owner's equity to reduce the owner's equity. Okay, so let's see what they give us beyond this, huh? Let's look at the closing process. Here we go. They don't give us any numbers, but they're just starting to show us the process here. You have revenues. How do we close the revenue? With a debit, right? Debit. How do we close the expenses? With a credit. And drawing, we close with a credit, okay? And all of those things are going to be brought up eventually to owner's capital. Drawing goes up directly. The net income temporarily is going to sit in the account called income summary, at which point we debit the income summary to get rid of it and credit owner's capital with the net income number. Credit owner's capital or owner's equity with the net income. To close an account is made to the opposite side of the account's balance, okay? Closing entries. If it's a revenue account, you debit it to get rid of it, and if it's an expense, you credit it to do so. Closing net income versus net loss. I don't want to look at that. Don't look at the net loss. Look at the net income. Capital at the beginning of the period was 1,000. And here's the income summary. They credited expenses for, now I'm confusing myself here. Oh, there's the revenues there. Yeah, they debited revenues to get rid of them, right? And they credited income summary. They credited the expenses to get rid of them, and thus they debit the income summary. So that leaves us with a balance of $1,000 here, and we get rid of it with the debit. Closing entries are not hard as long as you understand why we're doing them. That's important. Why are we doing these closing entries? And the answer is to update capital to its new balance at the end of the month to reflect the net income and the drawings. And this is probably a little bit better presentation here. Let's take got the happy fingers going here. Hey, let's take a look here. Mitchell Williams Capital, huh? Let's start with the revenues. He only had one revenue account, delivery fees. The balance was 8,000. How do we get rid of that? How do we close a revenue account? We close it with a debit because revenues have a credit balance normally. So that debit to delivery fees goes there, and the offsetting credit is now in the income summary. So at that point, we put the sales into the income summary. We must do the same thing with the expenses. And you are going to debit, you're going to not debit, but you're going to credit each expense. The balance was 2,050. We credit rent expense. We credit supplies, phone, whatever. We add those numbers up, whatever the number adds up to, and they add up to 3,360. Debit. At that point, we have a balance of 4,640, which is your net income. And now all we have to do is move that net income into capital. So look at Mitchell's capital. It was 5,000 at the beginning. He withdrew 3,000, so that makes it 2, plus the 4,640 is the new capital number. I just want to see something here. Okay.
Bob, can you go over number 3 again?
Yeah.
The step number 3.
Okay, let me go back to step number 3. Step number 3 is when we close the income summary. Step number 1 is pretty easy. You debit all the revenue accounts. Step number 2, you credit the expense accounts. At that point, what is sitting in your income summary account is the net income, right? Net income. So the summary account should have a credit balance, hopefully. If you made money, it'll have a credit balance. So we're going to get rid of that credit balance with a debit to the income summary and a credit to owner's equity. And let me show it here again. Take a look at the income summary. it had zero balance by definition to begin with. Always zero, it's always zero, except for this one moment. We closed the revenues, that put the sales here. We closed the expenses, that put the expenses. The balance in the income summary is now a credit balance, hopefully, of whatever the number is. And we close it out with a debit and credit owner's capital. Make a little sense, Christine?
So wait, so you're basically just doing the opposite two different times. So we
Yes. Yes, you're
Like
doing
ping
the
pong.
opposite. Kind of like you guys have been doing the whole semester. No, I'm only kidding. Yeah, no, exactly. That's a good way to say it. Yes, the opposite. You're
How many-
rever-
so we start when one spot, and then we do the opposite, and then we do the opposite again to get to the owner's
Yes.
capital.
yes,
But twice.
yes. By debiting the revenue accounts, which have a credit balance, and by crediting the expense accounts, which have a debit, you have come up with a balance that equals the net income. And it's that net income that now gets moved over to owner's capital. And drawing just goes directly to owner's capital. Okay. Any other questions? Anything not clicking yet, or? I will continue. Yeah, this is what we were just looking at, right?
Mm-hmm.
How everything rolls up. Roll up, I say. Revenue rolls up to the income summary, 8,000. Expenses, you add them all up, they're 3,360. The balance in this account is now 4,640. You debit it and credit. Now on the test, they'll give you a tricky question or two that might sound like this. True or false? If the income summary account has a credit balance, the company had a net loss, true or false? Anybody want to think about that one?
Wait, sorry, can you repeat what you said?
Yeah. If the income summary has a credit balance, that means the company had a net loss, true or false? And I would say, look at this here. We have a credit balance here, right? Credit balance.
That'd be false.
That
False,
means
yeah.
that they made money. So that question would have been false. It's kind of a tricky little thing, but it really makes you think for a second. So maybe on a piece of paper as you're answering these questions, maybe make a little helper to yourself. Maybe write a T account down, income summary, you put a credit there, and you say, wait a minute, it says credit. Well, that means I'm going to debit it, which means we made money. A little warning on the type of tricky questions they like to float our way, okay? Look at the journal entries. Look at the journal entries. This is what you were asking about, Natasha. Delivery fees. Well, you've been crediting them all month. Every time we had a sale, you debited cash or accounts receivable and you credited delivery fees. And that income, that revenue went up, 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 up. And by the end of the month, we had $8,000 in total sales. We debit the sales account, we credit income summary, and we do the opposite with the expenses. Expenses all have debit balances, right, Nastasia? And we credit each one. Credit, add them up. We now have a balance in there of $4,640. That's our famous net income. So now we can take the balance of 4,640, which is sitting in the income summary as a credit. We debit it. And now Mitch's capital is updated properly. And then finally, we just take the drawing and get rid of it with a credit, and the debit reduces Mitchell's capital. Okay. Questions, comments? Not too tough, huh? Not too tough, I don't think. And then when we've done this, when we finally wrote all these journal entries and updated our general ledger, there's only one more report to do. You're going to print out what's called post Post-closing trial balance. Think of it as the post-game show, the post-closing trial balance. And one question they might have on the test might be, revenues and expenses appear on the post-closing trial balance, true or false? They don't appear. That's the whole point. They don't appear. Post-closing trial balance, prepared after you do the closing entries. And all it does, again, is prove debits equal credits. And the only thing you're going to see are the balance sheet items. So take a look at your post-closing trial balance. I don't see anything below capital, do you? No. The post-closing trial balance is simply your balance sheet. No income statement. Of course, the very first second of the new year, a customer walks in and buys something, then you'll start seeing some activity. But at that point, we have zeroed out the temporary accounts. Temporary accounts get zeroed out. They are your income statement, your revenues and expenses. I don't know if we want to go over this, steps in the accounting cycle. But let's look at it, because this is kind of what we learned here, right? Let's talk about it a little bit. What do we do in the accounting cycle? We're looking at source documents. We're assuming that everything that goes into our general ledger can be supported by a hard copy of a piece of paper, is basically what we're saying, okay? Source documents, invoices, receiving reports, purchase orders, purchase requisitions, sales orders and requisitions, payroll checks, the checks that we write. Could be just a copy of a text or an email. The boss is on vacation and she says, quick, wire me $5,000. Well, based on that text, you would do it. You would probably print that text out or take a picture of it to get it into a paper format and staple it to the journal entry and send the check out. So what do? We analyze source documents. We write journal entries. Chapter 3, you were introduced to journal entries, the general journal. Once you post them, they flow right into your general ledger. And when the general ledger is at the date at the end of the month, when you come to the final general ledger, you are going to prepare a trial balance, and then you're going to prepare your adjusting entries. Remember the adjusting entries? There'll be a lot of that on the test. The adjusting entries. And when you do that, you're going to come up with a new worksheet. You're going to compute a new worksheet, and you're going to journalize these entries and prepare the financial statements from them. Then you journalize and post closing entries, and you prepare the post-closing. And that's typical for any business. I mean, that's basically it. It's been the same since the 16th century, when an Italian monk invented this bookkeeping system. He invented it in 1494, actually, 1494. The Church, the Vatican in Rome, felt the need to have very good accounting type systems. They needed a way to keep track of their business. What event occurred 2 years before 1492 that probably drove this decision? What happened in 1492 historically? Anybody remember?
Columbus.
That's exactly right. In 1492, Columbus sailed the ocean blue, discovered America. And suddenly, you were moving huge quantities and different new products all over the place. You know, they discovered tobacco and molasses and all this kind of stuff they didn't have in Italy or in Europe. They needed systems to guide them. And that's what this guy came up with. Luigi, I forget his last name. It's irrelevant. Okay. Totally irrelevant. It will be on the test, though. I'll make sure. Steps in the accounting cycle. And that's kind of the whole chapter. Not much to it, but it's kind of crucial. Cash flows, if you take Accounting 230, you will have a big, long section just on cash flows. The only thing you need to know about cash flows for this course are what are the three types? What are the three kinds of cash flows? Operating, which is where you want to see the cash coming from. You want to see that cash is growing because you're selling your product, because your expenses that you're paying are much less than your sales. Operating cash flow activities, anything done in the normal course of what the business does. And I always use Coca-Cola as my example. Coca-Cola produces soda and snack foods and waters and juices. That's what they do. But sometimes Coca-Cola says, we're going to buy a big giant bottling machine. We're going to go out, we're going to spend $1 million on a machine that'll screw this thing on in 1/100th of a second. That's an investment. That has nothing to do with making the soda necessarily, because the business is not there to invest in big, heavy equipment. It's there to make soda. If they invested in another company, if Coca-Cola had a lot of cash lying around, they could buy Microsoft stock if they wanted to. Financing is borrowing money or issuing stock to raise money. And then they give us some examples here, and I don't think you really need to go through that. Statement of cash flows. If they put this on a test, you guys are dead, because the 230 people can't do that one. Okay. So anyway, this chapter kind of stops right here. Just know investing, financing, and operating. Okay. And that's really all I got for you today. Any questions, any fears, any thoughts? You okay, Eric?
Yeah, it was pretty basic, I think, this chapter.
Yeah, the closing entries tend to cause confusion. You might go back to do your homework now and get a little lost in the weeds there when you start working through the income summary. Looks like you were keeping up pretty good, Natasha. Is that correct?
We'll see. I read the PowerPoint before class, and it seemed to help because it wasn't like deer in headlights. But I still got to read the text.
Good thinking. Yeah, no, I think you're right. Reading it. How about it, Patty? Do you have any problems with this?
Kind of. I mean, admittedly, when we were going through it, I did kind of end up thinking that the income summary, I thought it was weird that I thought it was backwards. And that's why I got, when you asked the question wrong earlier. But also when I was thinking, I'm like, why is it this way? This seems wrong. Like it just seemed intuitively wrong, but I still thought it was that way from how we were going through everything.
Yeah, so you feel a little bit better now then?
Yeah, I feel better confirming that I was justified in my belief.
Okay. And we'll end up, let me just see something here. Hold on. Hi, Christine. You have any question, Christine? Any comment?
Hold on. Trying to figure this out. No, I just no, it's fine. I just did a bunch of closing on my own
Okay.
book. So I get it.
Excellent. Excellent.
Yeah.
Yeah. Is that Krista I see there?
Hi there.
Krista, right?
Yes,
Not Blake. Okay.
Blake's my last name.
Okay. You ain't Blake. There is some actress named Blake, though. I can't quite remember her name. But anyway. Are you keeping up with us now, Krista? Or are you?
I'm keeping up. It's just all a matter of practicing it. I've never
Yeah.
done this before. So it's a matter of running through it several times. So it solidifies my head.
Yeah, absolutely. Doing it a little bit makes a big, big difference. Did you get any help like you were asking about?
You know, the person you put me in touch with is out of town. So it would just be via Zoom. So
And you
that-
wanted,
I'm wanting to, in person, just to kind of talk through some of this stuff.
I have a guy who would be very good, but there's one physical problem. He has his leg is amputated at the knee. Where you could probably meet him though at a coffee shop or something. Would you want to do that? Okay.
Sure. Yeah, maybe give me his contact and I'll see if I can arrange them.
Absolutely. And you know what you're gonna like about him? He's a student of mine. He's older than me. So you get along with Bill, okay? All right.
Sounds good.
So you'll get a text from Bill. All right.
Okay.
What do you think, Krista? Call the meeting now? Time to make a motion to quit?
Yes.
Okay. Hey, you take care, everybody, okay?
Happy holiday.
Thank
Bye, everyone.
you.
So, see you later. Bye-bye.
Thank
Bye.
you.
Everyone. Bye-bye.